the fundamental underlying assets are rental housing. And right now in this market, as we sit here today, rents are going up. Occupancies are at all-time highs. Delinquencies are at near all-time lows. The performance of the actual asset class is doing great.
So Don, let's just talk. Let's start with the top. Reasons someone, might be concerned. What are the top either objections and or false beliefs or just concerns that people have as it pertains to the lending fund? And then let's kind of talk through that, and then let's show the you're going to share your screen here after that, and we can kind of dive into the actual numbers and the data behind it and the performance and such. But what would you say? Someone saying, "Hey Don, I'm invested with you now, or I'm considering it, but I might be concerned." What comes to mind, would you say, Don, when for some of the hesitations someone might have?
Yeah, great question. I think the probably the biggest concern or perception is that property values are going to rapidly decline, and that just in general investing in the general term of real estate is going to be at risk, right? The property values are going to go down. I think that's the big overarching kind of concern people have today. And I think the people who maybe are a little bit more in tune and understand what we do as lending, construction, bridge, financing to real estate developers and operators, I think the next really big concern is, well, are they going to be able to get your loans paid off? Are they going to be able to sell the property or get permanent financing in this market? I think that's probably the second biggest concern, or maybe the biggest concern for those who have a little bit deeper knowledge of what we do.
Excellent. So
explain kind of the answers to or feedback to that. But
yeah, so let's talk through that, right? So I think that's a good point, right? It's on the 2008 crash. We saw property values. It took about 3 years to go to the bottom in real estate. Different market, different shift for a lot of reasons. But what I love about the DLP lending fund is that I think the average loan to value on these first senior mortgage positions is about 55%, meaning there's about 45% of equity already built in. And so let's just imagine there's, 5 properties and $10 million worth of loans on 5 or 10 properties. The average equity on that 10 million total value would be, 4.5 million. The loan is about 6.5 million. A lot of margin between where, in my mind, how I would see it, Don, is, the actual asset, if it was foreclosed on, right, and the value drops drastically, to actually have the investor start to lose the money. Or walk through that so people understand that concept there.
Yeah, absolutely. Great lead in. So right now our average loan to value is, to your point, Brett, 52%. So that means, to use real numbers or semi-real numbers, we have $1 billion of loans right now in the lending fund out against nearly $2 billion of real estate. And mainly that real estate is housing that is and remain affordable for the local workforce. So think of $1,000 a month, $1,200 a month, $1,500 a month rentals, mainly across the southern states in the United States. And so from a practical standpoint, the risk that property values are going to drop by 50%, and we're going to be upside down is a pretty extreme expectation, again, in affordable workforce housing. In Florida and Texas as our top 2 states. The expectation that's going to happen is hard to expect that to be at all practical, but because these are how the fundamental underlying assets are rental housing. And right now in this market, as we sit here today, rents are going up. Occupancies are at all-time highs. Delinquencies are at near all-time lows. The performance of the actual asset class is doing great. And a lot of the things that people are concerned about, such as the incredible growth in interest rates in the past year, are only forcing more people to be renters. Right now, we have the largest gap between what it costs to rent a house and what it costs to own a house right now in America since 2006. It's $1,376 more per month on average to own a home than to rent a home in the average market across the United States, meaning more people have no option but to rent. Even though rents have gone up a lot and are still going up, the cost of home ownership because of interest rates has gone up so much faster that more and more Americans are choosing to rent, choosing or not having the choice, but to stay renters longer. So the fundamental performance of the asset class is great. So to go into that doomsday of, all right, property values were to drop 50% tomorrow and we had to foreclose on all of these properties. Well, if we did so, we would take back these properties at north of a 10 cap rate, meaning we could generate a 10% cash on cash return just off rent without any leverage, without any sales. We could generate 10% returns on a monthly basis. That's a really phenomenal place to be. To give you an idea, multifamily, single family housing has been trading at about a 4 cap rate for the last many years. So we're in a great position that if we did take back the properties, we could own them, operate them, and generate cash flow. And that's the other side of what DLP does. We own 18,000 units right now that we own and operate. So taking back the properties and operating them and managing them is something we do every day. But to give you an idea, we've done 5,000 loans over the last 9 years in this fund. We've never written off $1 of principal or interest on a single loan, let alone having all of our loans go bad, right? We haven't written off $1 of principal or interest on a single loan in 9+ years, 5,000+ loans.